Hello, good people. Welcome to Certified Business Solutions, where we discuss business-related matters. I hope and trust that you are doing well. As for me, I am doing quite well. Today, we are going to talk about accounting, why it is important for your business to keep proper records of accounting. How are you, Dr. Kamau?
Fine, thank you, Lucy.
You're well?
Yes, I'm well.
Please, you can start us off by telling us what is accounting.
Yes, what is accounting?
Yes.
Maybe I can start off by saying the importance of accounting.
Yes.
Because it is a pandemic with the small business owners that whenever they go to the financial institutions looking for credit, they want to borrow, and they are asked to take to the financial institutions audited financial statements, they are not able to provide that. And in the event that they engage an auditor, the auditor struggles to get the records for the last 1 year, for the last 2 years, for the last 3 years. Because for someone to prepare audited financial statements, then you need to know how much sales were done in that year. For instance, we are in 2023. If you go to the bank today, and you want to obtain a loan facility using your business, they will tell you to provide them with the audited financial statements for 2022, 2021, and 2020. So you can imagine someone who does not keep proper records of accounts, all of a sudden is being asked, tell us how much you sold in January 2020. What did you buy in January 2020? What was your profit in January 2020? So at the end of the day, the small business owners, they end up losing an opportunity to get financing, to get funding, or even to attract an investor. So accounting basically is a process in which an entity records and classifies, then summarizes all business transactions with a name of preparing something called a financial statement. And financial statements, there are two main financial statements. We have an income statement, and we have a statement of financial possession, which used to be called or to be known as balance sheet. And income statement used to be known as profit and loss account. So basically, accounting is a process of recording, classifying, summarizing, and interpreting all financial transactions with the purpose of coming up with financial statements.
My other question is, what is the key element in accounting?
The key elements in accounting, it's like now the ingredients. Ingredients. The key components. Like if you're talking about a car must have tires.
It must have an engine.
It must have an engine. It must have doors, because you will not access the car through the windows. Yes. So the key components of accounting, there are three. We start with the one is the assets. Assets. Then we have liabilities. Then we have capital. There's no single business transaction that you will ever do without either affecting assets,
liabilities, or capital.
So assets, if I can define, assets these are the resources that the business has and which are supposed to benefit the business in terms of for it to operate. Assets are of two types. We have current assets and long-term assets. Current assets are the assets whose benefit will accrue to the firm within a period of 12 months. Usually this is something like stock. Like stock. You can, for instance, we take an example of a supermarket. The packets of milk that are there, loaves of bread, the all furniture,
the items in that supermarket.
Yes, everything that is for sale is stock. And that is current asset. That is current asset. So current asset is the stock. Is also, if you sold some of your stock on credit, the people who owe your business money, who basically they are referred as debtors, those what they owe you, now the debt, is
a
current asset.
Okay.
Another current asset could be the money you have in the bank.
Yes.
Either in your savings account or in your current account, or the money that you have at hand.
Yes.
Somewhere, not necessarily at hand, but maybe somewhere
around in that business.
In your business,
that premises,
in that premises.
Yes.
So those are the current assets.
Okay.
Long-term assets are the assets whose benefit will accrue to the firm within a period of more than 1 year.
Yeah.
And you remember, an asset can be either current or long-term asset.
Yeah.
For instance, this chair that I am sitting on, if it is in a certain business, and this business is a furniture shop, is a furniture shop.
Yeah.
So if this chair is on sale in that furniture shop, is it a long-term asset or is it a current asset?
It is a current asset.
Okay. Thank you. You're a good student. What if this chair is the one that is used by the accountant of that shop?
It is a long-term asset.
It is a long-term asset.
Because
Yes. So we cannot come up with a list and say this list is for all the current assets, and this other list is for all the long-term assets. Whether an asset is long-term or short-term depends with the nature of the business.
Okay. Or the use of that asset.
Or the use of that asset.
Whether it's for sale, it's for use in the business.
You see, like this is an apartment.
Yes.
This an apartment, it could be an apartment. Is it a long-term asset or a short-term asset?
I think it is a long-term asset.
It is a long-term asset. Yeah. But again, what if the developer, the person who owns this apartment, actually develops properties and sells?
Then it should be a current asset.
So it's a current asset.
Yeah.
So it doesn't matter what we are talking about. It is the nature of that business.
Yes.
So current assets and long-term assets.
Yes.
Long-term assets are the ones that benefits accrue to the firm within a period within a period longer than 1 year.
Yeah.
We go to liabilities.
Yes.
Liabilities are the obligations that the firm owes to other people.
Yes.
Maybe the firm, if it is a supermarket, there are people who supply goods and commodities to that supermarket on credit.
Yeah.
Maybe the supermarket has a credit policy that once you supply us, will pay you your money within a period of
time,
maybe 30 days, 60 days, or 90 days.
Yes.
So as long as these suppliers have not been paid, then it is a current liability. So the suppliers, maybe you have not paid wages, you have not paid salaries, you have not paid rent, you have not paid taxes. All those are current liabilities.
Yes.
What if you wanted to open another branch somewhere of a supermarket?
Yes.
Probably you are in Karen, you want to open another branch in Kileleshwa. Now you go to the bank and you tell the bank you need some financing. And the bank, after you have provided them with all the financial statements they have asked you to provide them with, and you have met all other requirements, they give you like 50 million. Now, this 50 million, you will not pay it to the bank within 1 year.
Yeah.
You will have a discussion with the bank and tell the bank that I wish to pay this 50 million within a period of 20 years.
Yes.
No, that's a long-term liability.
Because it is
payable within a period more than
1 year.
That extends for more than 1 year. Long-term liability. We come to capital.
Yes.
Now, capital is everything that is left when you take assets, you less liabilities, you have your capital.
Okay.
When you take all the assets, less liabilities, what you have is capital. Capital, we cannot say necessarily capital is the money that the owner contributed to the business. It is supposed to be like that, the money that the owner injected into the business. But that was then. Maybe 2 years down the line, you have accumulated so much debt and liabilities that you no longer have capital. That we say assets minus liability, it is coming to negative. You have assets worth 10 million, you have liabilities worth 20 million. So the capital, so you're having negative 10 million.
Capital.
If you can still call it capital, it's capital.
Though it is not there.
It is not
negative,
there.
Yeah.
It is now, liabilities are more.
Yes.
So the best definition of capital is when you take all the assets, less liabilities.
Yes.
What is left
is capital.
Okay. And the reason I'm saying that is because when a company is declared bankrupt,
yes,
when a company is declared bankrupt,
yes,
and maybe a statutory manager is appointed by the government, or a receiver manager, because what happens if a company is, for instance, there's a company that was recently put into statutory management. And some of the insurance firms have gone through that process.
Yes.
Even like something, I don't know whether a case, a SACCO, when it was struggling with the paying of the people who had saved with them. Now, let's talk with for an example, an insurance firm that has been unable to pay its debtors. Even Nakumatt, let me use actually a good example, Nakumatt,
yes,
because Nakumatt, and it's good because we are still talking about supermarkets.
Yes.
So Nakumatt, what it did, it accumulated a lot of debt.
Okay.
It was unable to pay its suppliers.
Yes.
So it came a point that it needed to be liquidated. The suppliers actually, first of all, they go to the court and they say, we have been doing business with Nakumatt, and they have not paid us. We want them to pay us, but they are not paying us. So after the court has listened to both parties, now it says if there is no other solution, then the company needs to be liquidated. So all the assets of that company are sold.
Okay.
Then every other debt is paid off. If we have received 100 million after selling all the assets of Nakumatt,
yes,
of course it was more than that. 100 million. First of all, we need to pay the government. If there were taxes that were outstanding that Nakumatt had not paid to the government, the government pays itself. First.
Before paying the other.
Yes, before paying even the employees.
Really?
Yeah, that's. So the government takes its taxes.
Share,
it's 100 million.
Yes.
You want the government to take taxes worth how much?
Is it
that percent, 30 million.
Yeah.
So we are left with 70 million. From 70 million,
yes,
then we come to registered creditors. These registered creditors are people, for instance, a bank had given money to Nakumatt supermarket, and Nakumatt supermarket had attached some of its assets, like a piece of land.
Yes.
And they had said, this piece of land, you can have it
if we don't pay.
If you don't pay, and this is the title.
Yes.
This is now the security for the loan that you are giving me.
Yes.
So when now the Nakumatt assets have been liquidated, not the bank whose loan has been registered will rank first before even the employees.
Wow.
So the bank will say, yes, you have sold, but we already have had an agreement, and this is the agreement. I had registered the debt.
Give us our share.
Give us our share. We say 40 million.
Yeah.
So we are left with that million.
Yeah.
Now that million is now we pay employees, and we pay any unsecured loan that was issued to Nakumatt. Any unsecured loan,
What about the suppliers? We have not paid the suppliers yet.
Even now the suppliers come there as any unsecured creditors.
Okay.
Any unsecured creditor, any unsecured loans.
As
so
the
suppliers,
last option.
As the last option. Now the suppliers, they in our hypothetical example, they needed to be paid 50 million.
Yes.
Because we only have 30 million left, and they are demanding for 50 million.
Yes.
So they will be given that million, they share.
Yes.
So in total, they will suffer a loss of 20 million.
Wow.
So we have not paid the employees. And who else have we not paid? The owners of capital.
Oh.
The people who had contributed capital.
Wow.
So that's why we are saying capital is what remains after you take assets, you less liability.
Okay.
So those are the key elements of any business.
Okay.
We have assets, long-term, short-term, liabilities, short-term, long-term, and capital.
Okay.
And capital is what remains.
Okay.
So what we have, and we have actually the accounting equation that every accountant should know. And of course, every business person for that matter. Yes. Because if you're in business, you have to know how to operate your business.
Yes.
You cannot be a driver and you don't know where the tank for the fuel is.
Yeah.
You can't know.
Where
you can't
the
be a
brakes
driver
are, yeah.
and you don't know where the brakes are.
Yeah.
You can't be a driver and you don't know how to open the boot or the bonnet.
That is true.
So when you go to the petrol station, the petrol station attendant is asking you to open the tank. You are asking now where
is it located?
Yes,
come and show me. Yeah, of course. Yeah.
Yes.
That is
so
true.
Every business person should be aware of this accounting equation. It says assets equals or assets equal capital plus liability.
Okay.
And that's why we are saying asset equal capital plus liability. Tupeleke liability pande ile ingine.
Yeah.
So this side we are left with capital.
Yeah.
So pande ile ingine tumeenda tukasema asset minus liability equal
capital.
Yes.
Okay. I get it.
Yes.
So the moment the capital is negative, that business is bankrupt.
Is bankrupt, but it can be saved.
It can be saved.
Yes, it can have investors who believe in the purpose and the cause of that business, and they feel this business have great potential. It's only that it has been suffering from poor management, and they're willing to pump in their money.
Yes. Okay. I get it. So of course, if there is a solution, that is good.
Yes.
So what is the most important element in accounting? Concept?
Yes, the most important accounting concept is a concept called double entry concept. Double entry concept says that every transaction affects more than one account.
Okay.
Or the effect of a transaction is not felt in one way, but it should be felt in more than one way. Okay?
Yes.
Now, for instance, it is a supermarket.
Yes.
Now they have ordered for 50 packets of milk. Now that's a transaction. This transaction will affect a number of things.
Yeah.
Will affect, and we said every transaction has to affect either assets, capital, or liability.
Yeah.
Now you have ordered 50 packets of milk, and you have been supplied.
Yes.
Let's even we for this time around we want to pay in cash.
Yes.
We want to pay in cash. So 50 packets of milk zimeletwa kwa supermarket yako.
Yes.
So that stock that you have received, how will it affect your assets? How will it affect your liabilities? How will it affect your capital?
So, because it has been brought to my supermarket.
Yes.
The assets will increase.
Yes. Your stock.
My stock will increase.
Yes.
Liability, I think it will remain the same because I have used the cash to pay.
Yes,
But on the other
you're a
side,
very good student. Yes.
The capital will reduce because I've used that capital.
Yes.
To pay for the milk.
For the milk.
So it will affect the assets.
Yes.
And the capital.
You are right and you are not right.
Why?
Because this time around, capital will not be affected. Remember, we said assets is the stock you have. Yes. So you are right, the stock has increased. Yeah. We are good to go. The stock has increased. Yeah. We also said cash at hand is current asset. Yes. Cash at bank is current asset. So if this person, you have paid him cash, then it is the cash at hand that has reduced.
It is the assets.
Yes.
Current assets.
Yes, basically assets have been affected twice.
It has
increased in terms of stock and it has reduced.
Cash, it has reduced.
Yes.
Okay, I get it.
Yeah, it's good to know that some transactions, they can affect assets alone. Others can affect only liabilities. Others can affect capital alone.
Okay.
Yes, so basically the double entry concept says that one transaction has to affect more than one account. Okay. Like now, in this case, the stock has been supplied. It has affected the stock account. The stock account has increased. Yeah. And again, the cash at hand account has reduced.
Yes.
Do you want to sell some stock? And then we see how it affects your business?
I want to sell 50 breads.
50 loaves of bread.
Yes.
50 loaves of bread.
Yes.
Now, how will it affect your business? Your stock, will it increase or reduce?
It is going to reduce.
Okay.
Because I had it in stock already.
Yes, yes.
It is going to reduce.
Yes.
Then cash at hand.
Yes.
It will increase.
It will increase.
Yes.
What if
yes.
this person who has bought 50 loaves of bread
yes.
have bought on credit?
I think I should give that to our viewers. They can help us. They can help us. They can help me. I know they will support me.
You're not running away from the question.
I'm not running away from the question.
So, Lucy's viewers, please come for her rescue.
Come to my rescue.
Yes, yes, yes. So the most important accounting concept is
yes.
the double entry concept. And we say when assets increase, there's a concept I would want to introduce about debit and credit.
Yeah.
When you draw a T account, you have a piece of, on your book, you draw a line, horizontal line, then at the middle of that horizontal line, you drop a vertical line, some sort of a T.
Yes, yes.
On the left-hand side,
yes.
that side is called debit side.
Left, okay.
On the right-hand side, it's called credit side.
Yes.
So for whenever assets increase,
yes.
you debit that asset account.
Okay.
So stock is an asset account. So you have procured more stock. You have added stock worth 50,000.
Yes.
So your stock you will debit your stock account by 50,000.
Okay.
Stock assets you debit when they increase.
Okay.
When they decrease, in case you sell now this stock of 50,000,
yes.
and maybe say there were 50 units and you have sold all the 50 units, now you credit.
Okay.
Whenever assets increase, you debit. Whenever assets decrease,
you credit.
You credit.
Okay. We are together.
Now, what happens when capital increase? When capital increase,
yes.
you credit. It is now the opposite of asset.
Yes.
When capital increase, you credit. When capital decrease,
you debit.
You debit. Liabilities, when the liabilities increase, you credit.
You credit.
When the liabilities decrease, you debit.
Okay.
You know that one, and you're a PhD in accounting. It is the most basic
yes.
accounting principle,
okay.
the double entry principle.
Yes.
When assets increase, you debit.
Yes.
When assets decrease,
you credit.
When liabilities increase,
you credit.
You credit. When liabilities decrease,
you debit.
When capital increase,
you credit.
When capital decrease,
you debit.
You debit.
Okay. So I'm a PhD.
I know you're a PhD holder. You just need to be conferred by the Vice Chancellor of your university of choice. Let me ask you an interesting question, yes. because it is something that confuses most people.
Yes.
When you deposit money in your account, bank account, what does the bank tell you? Does it tell you it has debited your account, or does it tell you it has debited your account?
I think it's like it says my account has been credited with this amount of money.
Is that true? And we have said money yeah. that is at hand or in the bank, yes. When you add, because money is an asset.
Yes.
When you add more money to your account, you should debit. But now the bank tells you it has credited, and you have believed all
yes.
those lies.
You want to confuse me because I normally say it has been credited.
Yes. Yes.
Why do they say credit and not debit?
Yes, and the financial institutions yes. should apologize to people for confusing people.
Yes.
Especially the non-financial specialist.
Yes.
Now, anytime,
yes.
don't listen to the bank.
Yes.
Every time your asset increases in value, yes. you debit. Ukipeleka pesa kwa bank, you had a balance of 50,000,
yes.
and you have deposited another 10,000. What you have done, you have debited that account
yes.
with the 10,000. That's why you have 60,000.
Yes.
So always know, even if the bank gives you a piece of paper saying you have credited your account,
yes.
no, you read it as we have debited. Now let me tell you why the bank says that.
Yes.
The reason the bank says that,
yes.
you have taken 10,000 to the bank.
Yes.
So now to the bank, it is a liability.
Okay.
To the bank, that money is a liability.
Yes.
So the bank is saying, we have, from the bank point of view, let's even leave the banks alone.
Yeah.
Now it is me and you.
Yes.
You have given me 10,000. I have borrowed 10,000 from you. Okay? So what I will do, if I have borrowed 10,000 from you, then my liabilities, yes, my liabilities have increased. So I will credit my liabilities.
Yeah.
So I will tell you, I have credited your account.
Okay.
Because I could be owing many people.
Yes,
someone called Omondi, someone called Mumo. So every other time I borrow money from Omondi, Mumo,
yes,
I know I owe them more money.
Yes.
So I'll tell Mumo, you have given me 10,000, so I have credited your account. The other person gives me 50,000, I have credited your account.
Okay.
But you'll say you have debited your account.
Yes. So now the banks credits it because, of course, the money belongs to me. So
it's a debt. It's a debt.
Okay.
It's a debt. But now, assuming now, I think the reason you would say you have debited is because, let's go back to the issue of the bank. It is the money that you have kept there. You have not given to the bank to use. It is the money that you are storing there. So it's like an account you have, a container you have there. Every other time you go, you put money in your container. So you are debiting your account. But because this container is in safe custody of the bank is considering that container, it's a liability. Because even assuming the bank was to be stolen, it has to refund you the money, to compensate you the money. So to the bank, as far as that container is within their premises or with them, it is a liability.
Okay.
But for you, it is an asset.
It is an asset.
You go there, you take the money that you want.
Yes.
You go there, you add some more. So whenever bank says it has credited your account, don't believe them. you know, that's your language, but me, I know you have debited.
Okay.
You say...
I think it's clear now. My other question is, you can explain to us, or you can tell us the stages of accounting.
Yes, the stages of accounting. It starts from when a transaction happens.
Yes.
It is a supermarket. You have sold some 50 packets of milk.
Yes.
You have received that money. So what will happen to your using the double entry principle, that transaction, you have sold 50 packets of milk, will affect your stock. The stock will reduce, and then the cash at hand will increase.
Yes.
Then that's just one transaction.
Yes.
So if you have so many transactions within a day, you will have sold loaves of bread, salt, all those things. So at the end of the day, you'll have a number of transactions.
Yes.
And what you are supposed to do is now to create something called ledger, general ledger.
General ledger.
Yes, where you put all your sales, so that in a given day you can say my sales were this much.
This is what I did today.
I sold loaves of bread, I sold this. My total sales during that day.
Is it only sales?
It's about all the transactions.
Even if I received more stock for milk,
yes,
I record it there.
You record it.
Okay.
So for instance, if we can say now the account for sales, the sales were 100,000.
Yes.
During that day, you spend some amount of money.
Yes.
I paid for milk. The supplier had come for his money. I paid for vegetables. I paid for this.
Yeah.
Again, that day, you have your total expenses.
Okay.
Maybe there were some vegetables that you had initially received as part of your stock, but you realized they were not good. Some of them had gone bad, and you have called the supplier and to come and take them back, or replace them with a more fresh supply.
Yes.
So again, you take account of that. You say goods returned to the suppliers, then goods returned inwards by our customers. Sometimes you can sell milk to a customer, and when he goes home, he realizes that milk was bad, had gone sour.
Yes.
So again, that customer might come back and tell you, now this is
you need packet of milk that you have sold me,
yes,
is not good.
Replace it with a fresh supply of milk.
Yes.
So you'll have again that kind of a list showing that because now that one will show the movement of your stock. So at the end of the day, you'll be able to know what is my stock.
Okay.
The ones that I was, by the time I was starting the business that day, I had some stock. During the day, I added some. During the day, I sold some, so I deducted. During the day, there were some that were brought back by the customers.
Okay.
And during the day, there are some that perhaps I returned.
Yes.
So you prepare general ledger accounts.
Okay.
From there, now you prepare something called a trial balance. Trial balance is, at the end of the day,
yes,
all these balances, for instance, if you have more assets, the assets will have a debit balance because assets will be the debit balance. You remember when we are talking about debit and credit concept, we say when your assets increase, you debit. When your assets reduce, you credit. So for instance, if your assets, you have debited your assets with a total of 50,000, but you have only credited with a total of 20,000. So debit side is more than credit side, yes, because credit side is 20, debit side is 50. Yes. So the difference is 30. So we say now the assets have a debit balance. So now when we come to the trial balance, you will arrange on the left hand side all the accounts that have debit balances.
Okay.
Maybe asset the stock for milk, for bread, cash at bank, all those assets we put them. The ones that are on the have credit balances, then you put them on the credit side, on the right hand side. Yes. For instance, all loans accounts will have a credit balance because we said if you borrow 50 million today,
you will not pay it within a day or a month. Yeah, yeah.
So, or let's say, for instance, suppliers. If you owe suppliers 20,000 and you have not paid these suppliers, yes, remember, whenever your liabilities increase, you credit. So at the end of the day, and whenever you pay them, you debit. So assuming the suppliers, you owe them 20,000, you have credited 20,000, and you have only paid 5,000. So at the end of the day, the difference between the credit side and the debit side is 20 minus 5. So it is 15,000 yes, in favor of the credit side.
Yeah.
So now we come to the general ledger, yeah, where we are putting now all out to the trial balance, yeah, where we are putting now all the accounts with credit balances on the credit hand side.
Okay.
So we say suppliers, we have a balance of 20,000. Yes. So after the trial balance, yes, you are good to go. You now prepare the income statement, okay, the profit and loss account. Then after profit and loss, you can prepare the balance sheet, okay, which is the statement of financial position.
Okay.
And that's now the entire accounting cycle. Okay. It starts from the transaction, it comes to the general ledger, it comes now to the trial balance, it comes to the income statement and financial, and now the statement of financial position.
Oh, okay.
And now once you have prepared that, there are people who would be very much interested to know about your business. If yes, any person is interested to know how your business is faring, that's what you give them, the financial statement, the income statement, the statement of financial position. Yeah. It could be the financial institutions. Yes. You want to borrow money from them, they will ask you for that, and they will ask for a three-year financial statement, and you will give them for 2020, for 2021, for 2022. Financial institutions, in case you want to borrow. So the lenders will ask for that information.
So generally, that is one of the importance of keeping the good accounting records?
Yes.
In case you want to get a facility somewhere?
In case you want to get a facility somewhere,
yes, because
these good financial records, yeah, will help any person to make a decision, and an informed decision for that matter. You will be able to know, now this institution, this is how it is.
Is it capable of repaying the facility they are asking for?
Yes, are they struggling? Especially now, it could be a financial institution, maybe an a potential investor, you have come to me, you have a business, and you want to tell me, now I want to take my business to the next level.
Yes.
You have a branch, and now you want to do more branches.
Yes.
Now I will ask you, can I kindly see your financial or interact with your financial statements?
Yes.
So that I can see whether you have the financial muscle to repay me my debt.
Okay.
Or even your concept, your business model is solid enough so that I can get convinced that this is a good business that I'm willing to invest into. So investors, financial institutions would be interested.
Yeah.
The suppliers, especially like now we are talking about the supermarket, especially now, for instance, the issue of Nakumatt. Any supplier who was rational and had interacted with the financial statements of Nakumatt would have known that the Nakumatt is experiencing liquidity problems, and he would have avoided investing with them,
giving
them
more supplies to them.
Yes, and there were some investors, suppliers who were very keen.
Yes.
It came during the last stages of Nakumatt. Most suppliers were demanding cash payments.
Yes.
I bring you vegetables, you pay me cash.
Otherwise?
Yes, otherwise we are not
business.
in business.
Yeah.
Otherwise we are not in business.
Okay.
As previously, the Nakumatt would push suppliers to come for money after 90 days.
Okay.
So suppliers would be willing and interested to interact with your financial statements so that you know.
But how do they interact with them?
Especially, it's a good question. Publicly listed companies, the companies that are listed on Nairobi Securities Exchange, they are required by law to publish their financial statements on a national newspaper or in a newspaper that has got national circulation.
Okay.
So that every person can read.
Yes.
When you say a newspaper of
every year.
Every year. Okay. Like now, by the time we are in February, by the time we are going to March, you'll now start seeing all financial institutions that are listed on Nairobi Securities Exchange putting their financial statements there.
Okay.
Just be keen, observe. You'll see insurance firms that are listed there.
So of course, when you see the red flag on the newspaper, so you run for your life.
Yes. Even they are supposed to put on a newspaper that has got a national-wide circulation. Yeah. They put on their websites.
Even in their websites.
It is.
Do they normally put?
They do.
So it's like
they do.
Wananchi, we ignore, or maybe we are not. We were not aware. Personally, I was not aware.
That's why we are here, Certified Business Solutions.
Yes.
So that we can inform the general public about what they need to know so that they can make informed decisions.
Yes.
So, assuming it is a private company, Nakumatt was a private company.
Yes.
How, if you are an investor, then you would go to the management and tell them that you need me to pump some money into your business. Then can I see audited financial accounts for the last 3 years, for the last 5 years? And they would be obligated to share with you. And what you need to know is once those financial statements have been approved by a registered auditor, like we are at Certified Business Solutions, then those statements, those reports, you can rely on them because they have not been prepared, though they could have been prepared by Nakumatt.
Yes, but they have to be certified by?
They have been verified and proved to represent the true and fair position of financial affairs of that institution.
By who?
By the auditor, who is certified. Because the auditor is independent.
How do we know whether an auditor is certified or not?
A great question. For you to know that, even financial institutions, when you go to the bank to borrow, what they do, because they have to ask you to provide them with the audited financial statements. And for them to prove whether the person who assigned those financial statements is legit or is a quack, they log into ISPAC portal. And ISPAC is the body that regulates the professionals who practice accounting and who offer accounting services in Kenya. It's Institute of Certified Public Accountant of Kenya. So you log into their website, they have a portal, there's a place that they have an icon saying registered CPA firms.
Yes.
So and once you key in, you click on that icon, it will lead you to a search.
Okay.
A window where you can search a particular name of an auditor that you want to confirm whether he or she is registered with ISPAC.
So if they are registered,
yes,
you find their name there.
Yes.
If they are not, you don't.
They are not registered.
So it's always good to work with the right people
with
for
the right people.
purpose. Okay.
And I want to let me say,
yes,
because you might get backlash from your viewers, because they might go to the website of ISPAC and look for certified business solutions.
Yes.
It is not there.
Who is there?
Who is there? Who is there?
Yes.
Is the company that we have registered to offer auditing services and taxation services and financial consultancy services is Minor Kamau and Associates.
Okay.
There's a law by ISPAC and all professional and all professional regulators, people who regulate the offering of professional services in Kenya, whether it is Law Society of Kenya, whether it is the one KPMDU, the one for dentists, whether it is the one for accountants, whether it is the one for lawyers. For you to be registered, you have to use your names as they appear in your ID.
Okay.
So, like, if I'm the one who is certified as an accountant, they cannot register the word certified business solutions.
They are going to register your name
as it appears in my ID.
Yes.
If you are partners, then, and my name is Maina, and your name is Wanja, they will say Maina, Wanja,
and
Associates.
Okay. So for certified, we look for Maina.
For certified. As we operate in terms of offering those services, we use the word Minor Kamau and Associates. Okay. You log into ISPAC, you will see where we are registered, how we are registered, and where our offices are.
So all the bodies, those bodies that you have said,
yes,
every person has to use their name.
Yes.
So if you want to check whether someone is legit,
whether it is an architect, an engineer,
you look for their name.
You look for their names.
Okay.
So we are saying suppliers, even employees. There's an employee who would want to know, is this a company I can rely on?
Yes. Are they capable of paying me?
Are they capable of paying me?
Yeah. Or they will take me in circles.
Okay. Yeah, so basically those are the users of financial information. The people who interact with financial statements, financial audited reports, so that they can make informed decision about a company. Even the government, because the government wants to know, this company is filing nil returns. This company is not filing any returns. Has it been making profits? Has it not been making profits? And that's when the government, if they consider that you are cheating them, they send investigators to come and interact with your financial statements. And even if they feel they don't trust your financial statements, they have an obligation to request for bank statements directly from financial institutions, so that they can see how you have been how you have been using your money. So even the government is interested for purposes of ensuring that you are paying the right tax. The right tax amounts.
All right. Thank you very much.
You're welcome.
Yeah. Our viewers, we hope that you have learned something about accounting, the importance of accounting in your business, and also importance of being in good record and good books. We hope that you have learned better and you'll do business better. See you next time. In case you have a question, you can always leave a question on the comment section, and we will get back to you.
Please tell our viewers to subscribe, to share our video, so that it can reach many people who would be in need of the information that we are sharing.
Yes. Please subscribe and
share,
comment, and ask your friends to subscribe, so that we share this information with everyone. Thank you.